Embassy REIT came out with the Q1 report card as well. The company's revenue growth is about 2.3%. Profit after tax declined due to higher depreciation and finance costs. The occupancy remained at around 85% levels. Let's get in some more perspective. Aravind Maiya, CEO of Embassy REIT, is with us. Mr. Maiya, thanks for joining in. Let's start by looking at rentals, because I think the rent has gone up and your DPU growth is also very, very healthy. You're guiding for 7% for the whole year, but looking at the way this quarter has gone, Q1, could you be exceeding your guidance?
Good morning, everyone. So honestly, yeah, I think I want to start by saying that FY25 is a year of growth for us. What I mean by that is, one, of course, our overall portfolio has expanded to 51 million square feet. Our DPU is expected to grow by 7%. Our rentals have grown over the year. So overall, very positive. And quarter one started in line with our expectations. We did about 1.9 million square feet of lease up, and DPU has grown by 4%. Overall, we are sticking to our guidance. We are expected to grow anywhere from 7 to 8%. So that's where we expect to be during the course of the year.
You've also hiked your gross leasing guidance to 5.6 million square feet versus 5.4 million square feet earlier. Can you tell us the reason why?
Yeah, sure. So beginning of the year, we gave a leasing guidance of 5.4. That's gone up to 5.6, largely because of some early renewals during the quarter. But I think just to give a sense of overall market, it's important to say that of the 1.9 million square feet, which we did this quarter, it's evenly balanced between, pre-leasing, new lease up, as well as renewals. Also, an interesting statistics for this quarter is we did a pre-leasing of 0.9 million square feet, 0.6 committed and 0.3 growth option with one of a large tenant, where we are actually redeveloping one of our existing buildings in Manyata. What I mean by that is we're breaking down an existing building, which is 0.3 million. We are constructing a new building, which is 0.9 million by utilizing our FSI. So all of this adds to the growth in the coming years.
Okay. In terms of, the outlook going forward, is the change in taxation going to impact you in any way whatsoever, the long-term capital gains tax change that's happened in the budget?
It was very positive for our unit holders. Just taking a step back, it's been about 5 years since we as Embassy REIT did the first REIT listing. At that point in time, we were about 4,000 unit holders. As we speak now, we are about 110,000. Which means there's a growing acceptance of REIT as an asset class. And one key aspect which we've been working with, various government bodies as an industry is to classify our units as equity or equity-like. So we believe that this, alignment of long-term capital gains to 12 months is a step in the right direction. What we now need is, index inclusion of units in various Indian equity indices that will enable more liquidity in our stock and also increase more of our unit holders.
Aravind, a lot of the business decisions are made keeping 5-7 years, the long-term picture in mind. We're talking about FY25, but if you could give us the picture for the next 3 years, what are the projections that you have on the various parameters?
Sure. I think when you look at over the next 3 years, right, the portfolio growth comes into play very significantly. What I mean by that is we have close to 9 million square feet under construction as we speak. Why we are very bullish on this is because this is expected to add close to 1,000 crores to our net operating income over the next 4 years. But I want to give 3 important sub-statistics, if I can use that word, on this 9 million. First of all, 100% of this 9 million is being developed in our 2 core markets, which is Bangalore and Chennai. Secondly, 6 million of this is being developed in Embassy Manyata and Embassy Tech Village, which we believe are probably the 2 best assets in India. And lastly, about 5.7 million of this is being delivered in the next 2 years, and 70% of this is already pre-leased. What that means is more or less this growth is kind of confirmed. So this, under construction or organic growth for us is a very important lever over the next 3-4 years, coupled with the fact that we expect a 5% escalation, which is inbuilt into our contract year over year. And lastly, the growth in occupancy. Today, we are at 85% occupancy. We have guided to a 88% occupancy by end of the year. And we believe our target is to go to a pre-COVID occupancy of around 95% over the next couple of years. So a good pipeline of growth in our portfolio over the next 3 to 4 years.
All right, Aravind, a short chat today. Thank you for joining in and giving us some perspective, and good luck with the rest of the year.